Someone once told me, it's not about how much money you make, it's how much you keep. What do you think about Trump saying that he's going to abolish the IRS?
Oh, man.
How would that look?
I think the key that people don't really think about is what you pay your kids actually has to be reasonable. Again, the TikTokers make it sound so much better because they don't care about the rule, right? I pay my kids and they bought a Lamborghini.
This is the True Hustle Podcast with your host, JR.
This is the True Hustle Podcast with your host, JR.
Someone once told me, it's not about how much money you make, it's how much you keep. And that has stuck with me. And now I hear everybody say it, right?
Yeah.
But
I think Robert Kiyosaki said that.
Yes.
And how many generations you keep it for, I think. That's his next one.
Wow.
Yeah.
And that's
He
deep.
built it up.
But you don't... I think back then it didn't really mean much to me. But now it means everything to me.
Yeah.
Because I think now you're in the... It won't
Now
speak
you're
for
making
myself.
money.
Now I'm making money. Now I'm like, all right. I don't like paying taxes. You know what I mean? Nobody does. You know what I mean?
Yeah.
So,
for sure.
I've been waiting for a CPA like yourself to come down and, bless us with some knowledge. So we have you here now.
Yay. So you're the audience are mostly, and you said obviously like entrepreneurs and professionals, but do they invest in real estate, most of them,
Yes.
or they all invest in something?
So the majority of our audience are like nurses, cops, entrepreneurs, contractors, realtors, flippers, investors.
Okay.
And they all don't like paying taxes.
Yeah.
So we all have that in common. So
Find me a person who likes paying taxes.
for real, huh? So now that we're on the topic of taxes, what do you think about Trump saying that he's going to abolish the IRS?
Oh man.
How would that look?
Well, so the goal
Enlighten me.
the goal was, I think, to have tariffs, right?
Okay.
Tariffs for the foreign countries to then sort of replace or start to replace income taxes. But if you really look at the numbers, it's not going to happen anytime soon, even if it ever happens. So, I mean, we have a lot of clients who are very excited about this whole talk about abolish the IRS. Forbes actually just came out, right? No, sorry. CNN just came out with an article that talked about abolishing the IRS. But the reality is it's probably not going to happen anytime real soon. And so it's still up to us to make sure we save on taxes until the day when that actually happens.
So when all the stars align and we live in a perfect world where there is no IRS, what is that going to look like?
Oh man, it's hard to say, right? Because if you think about it, the whole reason the tax law exists is for the government to incentivize us to do certain things. So the government incentivizes us to start businesses, right? To invest in real estate and provide housing. So if some of those benefits go away, I mean, it might impact, even with just real estate law, we see how it impacts real estate, right? When we had more lenient laws, higher depreciation and write-offs, more people bought real estate. When those started dwindling down, like right now, we only have 40% depreciation, fewer people are buying real estate. So it could potentially be a very different world if there's no taxes. The question, I think, is then how are we incentivized to do certain things?
And that's a great point because you brought up depreciation. And that is one of the biggest reasons why certain people buy and hold, right?
Yeah. I mean, I think that's one of the reasons. Because
there's multiple, but I think that's one of the key factors.
For sure. I mean, especially for people who are entrepreneurs and high income earners, right? Because the more income you make, the more taxes you pay. And that's the same for rental income. But rental income is one of the few asset classes where you could invest in something and get a paper write-off for it. Because depreciation is not just our down payment on a property. It's based on the whole purchase price. So it's basically the government saying, hey, go out, leverage, right? Use the bank's money to buy real estate, and I'll give you a tax write-off even based on other people's money that you've borrowed. So you can't do that with stocks.
I don't like stocks. And I had to whisper, I don't like stocks.
Because
sorry to you guys that do.
Because you'll get hate comments when you say you don't like stocks.
Well, if I'm going to be honest, I did dabble a little bit into the stock market. Yeah. And I lost a lot. And I waited for it to get back into the green. And when it got back into the green, I think it was 4 months before election, I took it out. because I didn't want to repeat of 2020.
Right.
And I didn't know how the markets were going to react. And I think I was trying to play it on the safe side.
Yeah.
And I said, I'm even. I don't care. I took it out. And now I'm building those ADUs with that money.
And I think that's the major difference between like stocks and real estate, right? In the stock, like you said, you're afraid of the market changing. There's literally nothing you can do to impact that as an investor of Apple, Tesla, whatever stock you're in.
No control.
But as an investor, you're going to build an ADU. You knew that before you bought the property.
I just think that there's various ways to leverage a real estate asset.
Right.
Versus a non-tangible asset like stocks. Like, you can't do nothing with it. All you can do is just be like, I hope the market does well.
You watch CNN and
watch
see the
CNN
tickers.
And all you see is red, red, red. Oh, Jesus. That was me for 7 months.
Yeah.
And I won't do it again.
Yeah.
Because I learned. And I always say, stick to what you know. And I didn't. Because I was trying to diversify. I was trying to do, this is what the wealthy do. But I got wealthy by building real estate, So why did I, But I just think that I was listening to maybe the wrong people.
Yeah. Well, I mean, but I think most people will say that the wealthy buy real estate, right? Wealthy people buy and invest in real estate. That's a part of most of wealthy people's portfolios. And like you said, tax is a big part of it because it's one of the only asset classes where you can have cash flow and appreciation without paying taxes on it, like you do with your W-2 job or maybe just like a business you own.
And that's the beauty of it. That's why I stick to real estate. And I diverted a little bit, but it won't happen again.
You strayed and you came back.
Yeah, I went right, and then I'm like, no, let's go back this way because it was just too much. So now that we touch on depreciation, how does depreciation work in real estate?
So depreciation is what we call a paper write-off. Paper meaning you haven't actually lost money. And I think a lot of times when people hear like real estate tax benefits and we talk about losses, they think, oh my gosh, like we're losing money in real estate. But the reality is depreciation is basically the tax law says if you invest in a rental property, the building itself is going to deteriorate over time. And because of that wear and tear over time, the tax code gives you a way to write it off over time. So normally if we're talking about residential real estate, you write it off over 27 and a half years. If we're talking about commercial real estate, office buildings, medical centers, you write it off over 39 years. So we call it a paper write-off because you're not actually losing money. You're just creating this loss based on deterioration or what the government thinks a deterioration table is.
So for commercial, you're talking about retail, warehouses, whether it's M1 zoning or whatever zoning, retail stores, that is depreciated 39 years and a half?
Yeah, no, just 39 years.
Okay, so 39.
Yeah, so the common confusion area people think is like commercial being commercial loans, like more than 4 units.
Yes.
But those are still residential. So residential is like somebody lives there, it's residential. I can do it over 27 and a half. If it's commercial use, like business use, then it's going to be 39 years. Yeah. But you would prefer for it to be 27 and a half because you're writing off more sooner, right?
So there's this trendy topic, right? Cost segregation. And I think some people use it out of context. I don't think they're as informed about it.
Yeah.
When should somebody do a cost segregation study on a property?
Well, let me tell you a little bit just in case anyone doesn't know what it is, right? So we said let's say a residential building, you write it off over 27 and a half years. There's a concept that's allowed by the tax code that says you can actually write it off faster. And that's what we call cost segregation. Also, people refer to it as accelerated depreciation. So instead of saying, I have this building, this podcast room that I bought for $500,000, it's made up of a bunch of different components. So there's specialty plumbing, specialty electrical, all these different things we see on the walls. And by breaking out those items, I can take faster depreciation on it. So I don't have to wait 27 and a half years. If on this $500,000 building, 100,000 of it are these component parts that I break out, I can write it off faster. So it's basically saying, hey, instead of waiting, 27 and a half years slowly to pay less tax, I want to pay less tax immediately today. And so it sounds very sexy, right? You're like, oh, I'm going to write everything off today. But before you go out and do that, you have to first figure out whether it's a right strategy for you. Like a lot of things in the tax world, what might work for JR might not work for me, right? So before you go out and spend money, ask your CPA, is this a good strategy for me? Can I actually benefit from it right now?
And I think that is so important. Like your CPA needs to be your best friend. And before you do anything, you need to call Amanda and be like, hey, listen, Amanda, this is what I'm trying to do. Do you think this is a good strategy for me? Not for Michael or Juan or whoever, for me.
Yeah.
Because everybody's tax situation is different because everybody's in a different tax bracket, correct? So is what works for me might not work for you.
Yeah. And also, like, what works for you this year might not be the best for you next year too, right? It depends on, like, even for you, like, how much income are you making next year? How many rentals are you buying or not buying next year? So it's always sort of like a working plan. It's not just set in stone. And also, not just what do you have going on from year to year, but the tax law changes year to year, right?
Yes.
So that Trump is president, 2025 might be a really great year of tax benefits, but it might not be. So there's all these different factors. But I love that you said, you know, your CPA should be your best friend. I don't know that they should be your best friend, but they should be your friend for sure. And I think a lot of people dread talking to their CPA because they only talk to them once a year. And when you do that, it's always bad news. Like, this is how much you owe. Did I hit
it's always bad news.
Did I hit
don't like
nerve?
April 18th when I had to pay that in full.
Yeah, it's April 15th.
I mean, April 15th, you know?
But the reality is, you know, if you talk to your CPA more frequently, like you said, before you buy properties, before you refinance, before you sell something, it's a very just friendly conversation. But in those conversations is how they can help you save taxes, right?
Yes.
So that's the only thing you have to do. You don't have to understand tax law or depreciation, but understand that you should call or text or email your CPA before these major decisions.
Absolutely. And I don't think that, you know, in this podcast, we're going to teach you guys or try to educate you on certain topics that you should know, but you might not know, but it's okay because the people that you hire, your CPA, they need to know. They need to be experts on it. And they need to, because at the end of the day, they're the ones that are going to run the numbers.
Well, and I think something that we see, unfortunately, a lot is people who sort of bring the ideas to their CPA. So that's a sign that you need to work with someone different. So if you're listening to this podcast and you're like, wow, cost segregation, never heard of that. And then you Google it, right? Watch some YouTube videos.
YouTube University. Then
you talk to your CPA and you're like, oh, you know, what do you think about cost segregation? And they got to look it up. If your CPA is Googling what you just told them,
if your CPA is Googling your strategy,
then you are the CPA.
Then you are essentially doing his job. So call Amanda. When would be, I'm trying to give him a scenario.
Yeah.
When would it be not a great idea to do a cost segregation study?
Sure. So the concept of cost segregation is that we're accelerating future deductions into today. So when is not a good idea? Well, if I can't use it today. So you might be someone who's, you know, full-time, let's say a full-time nurse, right? Working over 2,000 hours a year. And if real estate, if they just do long-term rentals and it's passive to them, then creating a big loss only helps them to offset passive income. So like from another rental property or they sold another rental. But it's not going to help them to offset their W-2 income unless if them or their spouse is a real estate professional. And so that's a common scenario where like, well, if I'm not able to use it to offset my W-2 this year because of my facts, then I don't want to accelerate it, right? Because I'm just accelerating something that I just can't use it. But if you're a high income earner and you're married to someone who's a real estate professional, then I might want to be able to do cost segregation because it can offset both my income and my spouse's income. So that's the common example is basically, can I actually use this benefit this year? If not, I don't want to pay for something I'm not going to use till the future. I might as well wait till the future to pay for that because they're not free, right? The cost segregations.
How much is the cost for something like that?
I mean, it depends on who you work with and the profile of the property. But for smaller single family, we've seen anywhere from like $1,000, $1,500 per property, all the way to, you know, large commercial real estate, $30,000 or more. what I really love about cost segregation is you never have to spend the money until you know whether you'll get a benefit, right? So if you're a real estate investor, step one, talk to your CPA and say, hey, do you think I'll benefit from a cost segregation? Because that's the first part. Am I going to get a benefit? Again, if they Google, end of conversation. But let's say they'll say, oh, yeah, sure, I think you can get a benefit. Then all you have to do is contact one of the many cost segregation firms. All of them will give you a free estimate. So the free estimate is, hey, give me the address of your rental property. They can look online and figure out what they think they can get in terms of acceleration. And then your CPA will calculate a number for you. So if, hey, this property will save you $15,000 in taxes and I'm going to charge you $2,000, great, right? Let's do it. But if it's going to save you $5,000 in taxes, I'm going to charge you $4,000. Maybe you don't really care to do that. So,
okay, all right. I always think, okay, you're going to accelerate the depreciation. So what if you're a buy and hold investor? Like, you would have to be bringing in major cash in order for you to do cost seg. Because if you're going to hold it long term, then I would feel like if I'm going to accelerate it, I got to be making a couple million so I could offset it in some way, somehow. Or am I?
Well, so an example might be, so you're a real estate broker, right? And so in your brokerage, you make $500. Oh, let's just say you make $200,000 of income, like commissions and such. And so the question is, okay, do I do cost segregation on my rentals so I don't pay taxes on that $200,000 brokerage income, or do I not and I just pay the taxes on that? I mean, depreciation is not creating fake deductions, right? We have the same set of deductions. We're writing off the purchase price over time. It's just whether I'm doing it now and pay less taxes now so I can reinvest my money and build an ADU, or I pay and
Smart.
save down the road, right? So it's basically the time value of money. And most people will say, I want to pay taxes later.
Nobody wants to pay now.
Very few people.
Okay. All right. Well, there you go. I hear a lot of people talking about it, but I wanted a thorough explanation from a CPA, not just somebody on TikTok.
Yeah.
That was like, you know what I'm saying? I'm not talking shit, but I'm just saying, like, no, I need a CPA here that's going to explain this to our audience and it's going to make sense, you know?
But the TikTokers are always better at it because they can sort of say whatever they want. And I can't, right? So like, oh, buy a single family and the cost like $10 million. And you're like, awesome, let's do it. But yeah, this is much better.
You're licensed, so we have something to lose here.
We have to
we can't just be like, hey, well, fucking, that's a great point. Now, okay.
But I will say something, because you just sort of mentioned like, hey, maybe it's a long-term hold, so I only want to do it if I'm making $1 million or $10 million. That's a common misconception that people think like cost segregation is only for large commercial real estate. It's only for people who make millions of dollars. But like I just said, a cost segregation could be as affordable as $1,000. So if you pay $1,000 to save $10,000 in taxes,
that makes a
that
difference.
makes sense. So you could be someone that makes $100,000 a year, and that could still make sense for you.
So you don't have to be making millions.
Yeah, you don't. It's just
if
you
it
did,
makes
it's
sense.
more.
If it makes sense, it makes sense.
Yeah.
That's awesome. Thank you for clarifying that for me. So now we're gonna get into the LLCs, because I think if I could count how many times I get a DM on my account asking me about the LLCs and the tax benefits. I'm not a CPA, but what I always say, well, a sole proprietor is a rollover entity, which, correct me. Okay, I'm going to let you answer it. I think I know the answer, but I'm going to let you answer
it.
I feel that it's just a rollover entity, and it's going to get taxed as if you were getting taxed on your personal.
Yeah.
Am I right or am I wrong?
Yep, you're right.
I'm telling you. I'm start answering all kinds of DMs. Not just kidding. So now that I have you here, is a LLC purely just as an asset protection vehicle versus a tax strategy?
It depends on what you do in real estate. So if we're talking about rental real estate, whether it's residential, commercial, generally, yes, it's just for asset protection. And the reason I say that is because regardless of whether you hold title in your personal name or an LLC or 3 different LLCs, they're all flow-through entities, like you said, right? So the entity doesn't pay taxes. It just ends up on your personal return. And if it's profitable, pay tax. If we have a tax loss from strategies, you save tax. So there's really not a benefit either way. But you're right. This is probably one of most frequently asked questions for me too, is like, what when do I have an LLC? Is it an LLC? So just for asset protection, if we're talking about rental real estate, long-term rental, short-term rental, midterm, all the same. If you're doing active real estate though, like real estate brokerage, commissions, property management, flipping, wholesaling, then there is a tax difference, whether you do it in your individual name or in an entity. Usually for active income like that, we want it inside of a corporation. And for most smaller investors, it's going to be maybe like an S corporation. And the difference is because if you're flipping or earning commission in your personal name, not only are you paying federal and state income taxes, you also pay an additional up to 15% self-employment tax, which is to like Medicare, Medicaid, all that kind of stuff. Versus if you're flipping or wholesaling in the S-Corp, then part of that money could be protected from payroll or self-employment taxes. So that's the reason. So entity or not, it depends on what type of income it is in real estate.
Okay, that makes a lot of sense. Now, you brought something up. I've heard different people that flip properties but hold title in an S-Corp. And I've heard people say, no, do not hold it in an S-Corp. Is there any differences between holding a flip property that you're only going to have it for a short term and a LLC or a S-Corp? Like which one is more beneficial and which one is right and which one's wrong? I mean, if you could say,
there's usually no right or wrong answer. And just like we said earlier, right, the taxpayer profile will sort of determine what it is. But at the end of the day, we want the profit of the flip typically to be in an S corporation so that we're saving on taxes. Now, the easier way to do, of course, is title is in the S corp, right? Title is in the S corp, we just flip it, now it's gone. But sometimes we do recommend clients have title in the LLC. Usually we do that when they're really unsure whether the property will be flipped or not. So sometimes you buy and you're like, I really think I'm going to flip it, but I might hold on to it. And so we have the property in the LLC so that you're just paying like maybe like a construction S corp to shift all the income there. And if you end up selling, you sell. But if you end up holding it, then it's held in an LLC. And the reason it's crazy like that is because, we just said flips in S corps, we don't want rentals in S corps. And so that's why if it might become a rental, we just don't ever want it to go in that corporation.
Wow.
Yeah. They make it crazy.
My rule is I will never hold long-term rentals in my S-Corp.
Yep. Great rule.
And I will only hold short-term rentals in my S-Corp. And maybe you could elaborate on this because now, even if you do make a substantial amount of money in 6 months, and let's just say we make $100,000, I could contribute some of that money to a 401k or to an IRA connected to that business.
Yep, you could.
I kind of know my shit, guys. Nah, just kidding. She knows way more. She knows way more. She's going to correct me right now.
Okay, so if you're saying, yes, rentals, right, long-term rentals in LLCs, flips and S-Corps, we contribute to retirement account, right? But you don't mean like Airbnbs, right?
No.
Okay.
I
Airbnbs are still rentals, so they are still in LLCs.
Oh,
you mean short-term flips.
Flips.
Yes.
Let's clarify that. I don't do Airbnbs. I don't do. I know a lot of my friends do, and salute to them. But I am not in the what is it called, the short term
tax loophole.
I
arbitrage. All the words.
Yeah, but arbitrage is something different. But I'm not.
Yeah.
This is straight flip or buy and hold.
Love it. Okay. So as long as you don't ever hold on to a flip, then no problem. The way you've been doing it is perfectly fine.
Perfect. So there is a loophole for you said for the Airbnbs?
Oh, no, yes, So Airbnbs, typically in the tax world, we call it short-term rental tax loophole.
Do you live in Southern California and are you looking to buy, sell, or refinance one of your properties? What better agent to represent you than the host of True Hustle Podcast? Go ahead, give us a call or send us a text at 323-352-7946. Now let's get back to the episode, baby. Yep, I heard about it.
And the reason it's called a loophole is because I was said earlier, if you're a nurse full-time, working full-time, and you have long-term rentals, if you're not a real estate professional, then your tax losses are passive. So they only offset income from other passive things. So you're still, what happens then is, you're someone making $200,000 as a nurse. You have these long-term rental losses through depreciation, but you're still paying taxes on $200,000 of your W-2 income because they're in two different buckets, right? And one of the ways to become a real estate professional is you actually spend more hours in real estate than your job. So I'm a nurse for 2,000 hours. I have to have more than 2,000 hours in real estate to be a real estate professional, which for most people who work a full-time job, they can't accomplish that. But if you invest in short-term rentals like Airbnbs, the IRS doesn't care how many hours you work at your job. You could potentially use the short-term rental tax loss against your W-2 income as long as you meet what they consider material participation hours. And that could be as low as 500 hours a year.
Really?
Yeah, or even you have 100 hours as long as no one else has more time than you, like your cleaning crew and things like that. So that's why you see a lot of medical professionals, just all kinds of professionals, right? People who are doing different things full time, real estate as a side hustle, invest in short-term rentals for that exact reason. So professional athletes, social media influencers, we have a lot of clients, just a lot of income. They'll never quit to do real estate, right?
Wow. I kind of partially knew that, but that's not my expertise.
Because you don't invest in short-term rentals.
I'm like, man, that's good, though. I'm intrigued now, but,
but that's the thing, like that works is you already do real estate full time. So you don't need it.
I don't need it.
It's actually just like a distraction.
But when I had my full-time job.
Yep. When you had your full-time job or for a lot of your audience who like, hey, I'm still a full-time cop. I'm still a full-time nurse. I'm a full-time CPA, right? It's a really great way for you to start off that way. As long as, again, 500 hours in your short-term rental. So that's after you acquire it, you stage it, you deal with like the guest turnovers, you schedule the cleaning crew, or even if you want to clean yourself, you have 500 hours. You can do cost segregation, pay your kids, write off all the furnishings, and have that offset not just rental income, but also W-2 income as well. So pretty powerful.
You said something very important as well right now. How much can somebody pay their kid on a yearly basis?
I mean, millions of dollars. The IRS does not have...
So there's no cap?
IRS does not have a cap to how much you pay your kids. But the concept of paying your kids is what we're trying to do is say, okay, if your kids are helping out in your real estate business, then the money you pay them is a tax write-off for you because it's a business expense. And then how much of that is tax-free to them? That's the cap you're talking about. And so right now it's about, I think it's about $13,000 for the year.
That's what I was referring to.
But oftentimes you might want to pay them more than that. So let's say you're someone who makes a couple $1 million and you're at the 37% tax bracket, right? Well, not only do I want my kids to have zero tax, but even if my kids had to pay 20% tax, I'm still saving as a family because I'm writing off at 37 and they're paying taxes at 15 or 20%, right? I think the key that people don't really think about is what you pay your kids actually has to be reasonable. Again, the TikTokers make it sound so much better because they don't care about the rule, right? I paid my kids and they bought a Lamborghini and they're only 18. So what you pay your kids actually has to be reasonable for what it is that they're doing. And so the age of your kid is somewhat important, right? Like an 18-year-old probably could earn a lot more money than an 8-year-old. So those are the things you're looking at.
That's great to know because I think people make it so easy, make it sound so easy online.
On TikTok.
And it's like, oh, Lamborghini. It's like, you're 16 years old. Like, wow. Okay. All right. Well, good to know. We touched on the LLCs. Now, I want to touch on the S-Corp, C-Corps. Those have tax benefits in comparison to the LLCs. what kind of tax benefits and how do those corporations get taxed?
Yeah, I mean, so S corporations first, because we'll talk about that because most of our investor clients are S corporations. So S corporations, again, are good for active income. Active income, flipping, wholesaling, property management, commissions, loans, right, for mortgage broker. So all that type of like earned income, it's good inside the S Corp because when that's earned in an S corporation, what happens is you take money out of it in two different ways. So one is you can pay yourself a payroll. And that payroll is just basically, you know, if JR wasn't doing what he did every day and paid somebody else to do it, what's like the lowest amount he could pay that person? That's required by the IRS. You're required to pay yourself payroll. And that payroll that you pay yourself, you actually don't save any taxes because you have to pay payroll tax, which is into Medicare and all that. But the rest of the money that you take out, it's called owner distributions, and that's the amount that you don't have to pay payroll taxes on. So theoretically, if you made $100,000 and we said, okay, $40,000 is payroll, $60,000 is distributions, well, on that $60,000 you took out, you're saving about 15% taxes on it. Versus if everything was earned in the LLC, you're paying self-employment tax on the whole $100,000. So that's the reason most clients with active income, they go to the S Corp. And the same concept for flips, right? If I'm flipping, I made $1 million. Well, if I did it all in my LLC, I'm going to pay self-employment tax on the whole million. But if I run it through my S Corp, I pay myself a payroll. Everything else that comes out, I'm saving up to 15% self-employment tax or payroll tax.
Wow. I have a S Corp, so that's good.
Are you paying yourself a low payroll?
Yeah,
Okay.
Yes, I pay myself. You know?
And a common mistake I think people make is that they kind of haphazardly do payroll. Like payroll meaning this is what JR needs for a living. JR's going to buy a Lamborghini. Let me give myself a payroll to do it. And you actually don't want to do that. You want your payroll to be some stated amount that's lowest reasonable possible. And then if JR also needed money to buy a Lamborghini, just take it out as owner distribution.
Owner distributions.
Yeah,
right.
That's the key.
Yeah. So is there a particular way you should be paying yourself, whether it's monthly, whether it's quarterly? And, okay, first let me ask you that question.
Yeah.
And then ask you.
So it depends on what the business is. You know, if you're a doctor or some, like if it's pretty consistent, typically we just say pay yourself monthly. For real estate, I mean, it's always so unknown and cyclical, especially for flips, right?
It's like a roller coaster.
We think we're gonna make $10 million this year, but we made 100,000. So for that reason, most of our clients in the space of flipping commissions, we always recommend low payroll, like monthly, but very, very low. And then in like the last quarter, then we bump it up and give you some bonus to catch up to where it should be. Because what you don't want to do is you don't want to say, hey, I think I'm going to make $1 million. I'm going to pay myself $300,000 of payroll, but by the end of the year, flip doesn't sell or sold, but we lost money, and your income actually ends up being like 100,000. You can't undo the payroll, right? The payroll already happened, already went to the IRS. So you always want to do like the smallest possible, and then bump it up at the end if you need to.
Smart. Is there a red flag when it comes to distributions? Like, is there like a limit? Like, okay, don't take X amount of distributions from your S Corp?
Not really. We typically recommend your distributions come out quarterly rather than every month, because if distributions come out every month, it starts to look like payroll, right? But other than that, I think the only other thing to watch out for is your distributions shouldn't be more than what the company made. So if the company made, $100,000, you payrolled 30, there's 70 left, that's what you take out. If you're wondering why would I ever take out more money, with loans. So sometimes an S Corp will go out and get a loan, SBA loan or some kind of collateralized loan. And then unknowingly the owner says, hey, there's some cash in there, let me take it out. That's where you might have a problem, because now you're not taking out what the company earned, you've taken out borrowed money. And that becomes taxable. So
that makes sense.
Yeah. So just take out what you put in plus what the company earned.
You guys in for a treat. Now let's talk about retirement. 401ks, IRAs. Is there a retirement account that you feel is better than, is there, do you feel there's one that's your go-to? Whether it's a 401k, a IRA, SEP IRA, Roth IRA.
Yeah. I don't have a favorite. I think it just really depends on, again, every taxpayer.
You're right.
So I hate to say it depends, but I will say if you're eligible for one, my favorite is the solo 401k. It's much better than like IRAs and SEP IRAs, because if you are a business owner, realtor or flipper or a doctor, if you have your own business and you're eligible for a 401k or solo K, you can traditionally contribute more money into it than like an IRA or a SEP IRA, like with the same amount of income. So that's what I really like about it. But also the 401k is the only plan that you can borrow from it. So we have a lot of clients who are like, hey, I would love to contribute money and write it off on my taxes, but I also want that money because I need it for a down payment. I need it for this rehab that I'm doing. And so in an IRA or SEP IRA, if you take it back out, you got to pay taxes and maybe penalties. But in a 401k, you can actually borrow up to $50,000 or half of what's in the account. And that's tax-free, penalty-free. So a lot of people, our clients at least, like that.
And you pay yourself with interest.
Yep, you're paying interest and principal to yourself rather than paying to a bank, right? So it's almost like fake interest to yourself.
Yeah. Did you know that? Oh, you're gonna learn a lot, baby. You better be taking notes, bro. You better be taking notes. You know what Thatcher say? Come on, man.
But I will say, for like a lot of our viewers, like there's a study that's, I think, more than 52% of Americans have a good amount of money in their retirement account, especially for people who have jobs, right? So really important to understand that if you're starting out in real estate, you're like, where can I get money for my first deal or second deal or whatever? Don't forget about your retirement account, because even if you have a job, you might be able to borrow up to $50,000 from that 401k, right, to use for real estate. Or if you have money from like an old employer, you can maybe roll it over into like a self-directed account and then use that for real estate. So there's a lot of different. We talk about buying real estate. It's not always just about the bank's money. Sometimes it's just your own money. Just know how to use it.
With the self-directed account, you could utilize those funds to purchase real estate and then put it back?
So in a self-directed account, so in the traditional retirement account, like work 401k, it's in like Fidelity or something like that, right? And it's invested in the stock market. The only difference in the self-directed account is you roll that money to the self-directed account, then you start shopping for assets. So it could be a rental property, it could be a note investment that I'm lending money to JR, right? It could be like a syndication. It could be all kinds. It could be a friend's restaurant business, right? All kinds of stuff. And so the only difference, again, it's still owned by the retirement account. It's not owned by you individually. So the only difference is instead of my IRA or 401k owning Tesla stock, now it owns 123 Main Street.
You brought up syndications. I don't do syndications, but I'm just curious to know how does the syndication operate, and how are taxes paid through syndications?
Yeah,
because there's multiple people dumping in money, and it's just you brought it up, and it's something that I always think to myself, like, how does that work? It's a loaded question.
Yeah, I mean, it's quite complicated, but I mean, from a CPA perspective, but for investors, it's actually pretty simple, right? If for syndications, I mean, I think we tend to, at least for me, I look at it as more of like a lazy investment strategy, because I don't have to do anything. Really, my job is to vet the sponsors, right? The syndicators. And then if I think the deal makes sense for me or not, that's it. So you give the money to the syndication, and then they do all the work. So when it comes to taxes, they do all the accounting. They'll do all of the cost segregation stuff, right? So they'll do all the write-offs and everything. And then at tax time, I just get a K-1 from them. So the form K-1 will basically tell me what is my share of the tax benefit, and then I put it on my tax return. So it's pretty simple from the investor's perspective. CPA, a lot of work, because some of my syndication clients have like 500 investors. And so one return is like a couple thousand pages.
Oh, no.
Yeah.
See, that's why I don't do that. I mean, for me, it'll be easy because I'll be the investor, but for you, it's horrible.
It is easy for the investor because you don't have to worry about any tax strategies. It's already done by the sponsors.
And the investors just get a K1.
Yep, they get a K1, and if you can use it against different types of income, great. If you can't, then you use it in the future against those types of income.
I agree with you when you said I think syndication is more like a lazy investment strategy, because ultimately you're saying here is my 100,000. I'm gonna leave it up to you.
Yep.
To make this grow.
Yeah.
All right. Sign some documents, fist pump, and cross your fingers.
Yeah, I mean, I think it's a little bit more control than like Tesla stock, right? Because at some point things go bad, you can vote and you can vote the guys out. So a little bit more control. But yes, I mean, you basically, and that's why I always tell people, like, don't invest in syndication because you see somebody on stage or on a podcast and you just really like them. You want to do due diligence. Like, I would search at a minimum, like JRN fraud, right? SEC. Like, I want to know complaints. Those are the keywords I want to search against the sponsor name and the company name, just to see, like, what kind of people are they,
I always advise, do not, that should be your last option, a syndication. I think investors should have full control of their own money, and they should be able to control the asset fully. I don't need permission from other people, or we need to sign here, we need to vote, we need to do X, Y, and Z. No. I want to control the asset. I want to leverage the asset. I want to do as I please with the asset. I do get a lot of messages asking me, like, oh, why don't you start a syndication and we could all, like, all your followers, we could throw in some money. No. Let me tell you why. Now you're going to hear it for the first time. I do not want to be responsible for your money, and I do not want to be able to have to deal with multiple people on one investment. I ain't got the time for that, and I'd rather teach you how to do it on your own. You don't have to go buy a 100 unit complex. Like, start small with your own money, and just taking one investment at a time. So for me, no. And I don't think I can.
I think on a similar note too, especially for people starting out, if like, okay, I don't have enough money, I'm going to partner with other people. I always tell investors, partnering is like a marriage. It's not just like, like you said, fist pump and shake hands and like everything's good. You should have all the very bad conversations up front. Like, what if we don't agree? What if I die? My wife's going to become your partner, right? So all those different things, because if you and your partner don't agree, then also you don't have full control over it. So I always recommend, whenever possible, if you need other people's money, take them on as debt investors. Like, you lend me the money, but it's still my deal because I want to control 100% of it. And I get 100% of the appreciation. I make all of the decisions, and I'm just going to pay you off. Right? I'm going to pay you back the loan, and then it's still my thing.
Which makes the most sense, I think. But I just think that people do go to seminars. People go do and listen to some people that are good at speaking, but they don't know much about the investment side, And it sucks for some people that they get fooled and they give their hard-earned money to somebody that's going to potentially lose it. I just can't, but inform yourself. You could, Google the, and see if they have any, fraud, or if they have any complaints, any, anything that could smear their name, but do it by yourself if you can.
Yeah, I think, at least as a first deal, we have clients who, like, they own a portfolio of properties and they get to a point where it's like, man, real estate sort of turned into a job, and I already have a job, right? Like, as a cop. So maybe I don't want to have 15 rentals. I'll have some of my money in the syndication. I think that makes sense because you kind of already learned how to do it yourself. And so you know how to look at deals. But for brand new investors who don't know anything, again, those are the kind of people who get, like, stargazed.
Yeah.
Like, oh, this person's great.
But even for seasoned people, I mean, I'm sure they're still going to do their due diligence and make sure they're aware of who they're giving their money to, because at the end of the day, it's harder money. I heard some horror stories. And I'm like, that sucks.
Yeah. Oh, I was going to say the reason I say those stories is because one is my own.
Oh, I want to hear it.
Oh, I mean, same thing. Like when I started out in real estate, I went to an event. There was a guy who was like, you know, said all the right things. And my husband and I were like, man, he's like a new syndicator. We really want to support new people coming up. And I used my 401k money, and there's no more. I mean, I still have 401k money, but that investment was gone.
Can I ask you? You don't have to answer. How much money?
It was $50K back then.
Still
Yeah.
$50K.
Yeah, $50K was a lot for like at the time when I was starting out too, or for anyone. I mean, today I don't want to lose $50K. No, thank you.
I don't like to lose $20.
Yeah, exactly. I don't want to pay for extra guacamole when I go to the store.
You know what I mean? $50K, I would lose it.
Yeah, yeah, and that's why I'm so adamant about telling people like you can't just hear someone on a podcast or on stage. You really need to like know because. They're in charge of your deals, right? Like you said, they're in charge of everything for the deal. So that's you're investing in that person. Like what exactly. JR is gonna do.
That's why I say no. Okay. I wanna, for educational purposes, for the people that are watching, like, what went wrong with that syndication?
Interesting. So what went wrong is kind of what we're seeing now. So this was many years ago, but I think similar things are happening in today's market. So basically, multifamily deal where it was a seller carry note, really good interest rate with a balloon payment due in X number of years. And
sounds like a great deal.
Yeah, one the idea was there's going to be forced appreciation and then natural appreciation and just refinance, right? Pretty easy. Refinance into a long-term loan. But didn't, the forced appreciation didn't really happen. Interest rates went up, basically more so than what the equity is. So unable to refinance, right? Unable to refinance into permanent financing. So you lose the deal. That means you're going to have to either come up with a lot more cash from all the investors to agree additional cash call to bring up the equity to refi or let the property go. And I say that cautiously because today, right now, we're seeing a lot of the same thing in multifamily. I mean, even commercial real estate, you and I were talking earlier about buying commercial real estate. So many are going to come for sale soon, if not already, for the same exact reason, right? People were banking on appreciation to refi for lower interest rate, but there has been neither appreciation nor lower interest rate. So now what do? You have to make investors give you more cash. And if they don't, then the deal's dead.
So you guys lost that property?
But they did.
Yeah, you didn't.
But I did. I lost my money. No, that was me too, yes.
And did he give you, did he say, hey guys.
Trophy? No, nothing.
I'm sorry, we lost this.
No.
It was no email apologizing, no letter saying,
oh, yeah.
Oops.
No, there's like investor communications and stuff. But I think at the end of the day, typically for those things, it's a group decision, right? Because they have to make a cash call. So are all the investors going to put money in or not? And so, yeah.
This is why me and Thatch get along very, very, very well.
Because I know Thatch thinks, he also says that if you syndicate, you just have a job, right? From the syndicator's perspective, you have a job.
And you're at their mercy.
Yeah. A little bit, yeah.
But you live and you learn. And I think that's a $50,000 lesson. So now, moving forward.
Now I can teach it to everybody else.
Yes. It costed you $50,000, but you're still here. You're still thriving. And people can learn from it.
Yeah.
This is the first that I've known somebody take a loss in a syndication. I hear it personally.
Yeah,
I've heard stories, but I don't know them.
Sure.
So it sucks that it happened to you. I'm so sorry.
Yeah.
But, you live and you learn. And people need to be careful because some people could paint perfect pictures on stage. I'm even in, whoa, I want to invest with this guy. And then I snap out of it like, no, I won't. You know?
Yeah, and then for me too, it was my retirement money. And so I always tell people, like, your retirement money is one of your most precious buckets of money because it's already protected from taxes, right? It's either growing tax deferred, which is great, or it's tax free if it's in a Roth account. And so whenever you're thinking about like what bucket of money should I use to invest, your retirement money should be investing in safer deals rather than, you know, the ones that may triple or may go to zero. So another of my mistakes that people could learn from.
There you go. I mean, I'm sure a lot of people right now are taking notes, and you know, they're taking. You better start taking some more. Okay, so after the syndication problem, did you change your strategy and you started investing on your own?
Yeah, I mean, we had our own property at the time. I think like a lot of people. So I started out my career as a real estate CPA. So after college, I went to work at one of the big 4 firms, and I happened to end up in the real estate group. And my husband and I started investing because he read Robert Kiyosaki's book, which, you know, like most people. And I mean, I think like most investors, we were super scared, and people found that weird. It's like, well, you're a real estate CPA, like that's sort of what you do, but they don't know that a CPA doesn't really teach you. Like a CPA license does not mean you know how to invest in real estate. So
it's different.
Yeah, we had to like go to the real estate meetups and go to the events, and we paid for a lot of boot camps and like learned all the things so that we can actually invest in real estate ourselves. And it was scary, you know. It was scary to buy our first property.
Absolutely, because a CPA does not mean that you know how to comp properties, that you know neighborhoods, that you know how to do this.
That's
cash
different.
on cash investments, this and that. Just like I am not going to be able to do a cost seg. I am not going to be able to do, a K1 or this. Or that's not my specialty. So it makes sense, you know, that it's not the same, you know, but it could be learned. You know, and it's going to take time, but I just think you being a CPA, it's like the icing on the cake, because now you know all the loopholes, and once you master the investment side, oh man, that's a beautiful combination.
I mean, I think for us, the sweet spot is just being able to work with investors and see, because like you said, you go to, I mean, anywhere you hear people talk about, I have these number of doors and all the great things. But as a CPA, we get to see the real numbers, right? So the people on stage who say those things, we know if they're actually true or it's inflated, and we get to see like where are they investing, how much are they actually making, and that's the part for us that's like super unique. Is most people don't get to see that. And it helps a lot with what we do in our investments.
You can say how it is, but your taxes could say something different.
Yeah.
What are some of the common mistakes that investors make in their tax returns? Or, I don't think I worded that correctly. What are some of the mistakes that they make in terms of their write-offs? Like, is there such thing as too many write-offs? Like, now you're killing your income, now you're showing negative. Like, what are some of the biggest mistakes that they make?
Well, I mean, I'll say two. One is just not maximizing it, because I think investors are really good about writing off like their interest and taxes and things like that. But a lot of people don't maximize what I consider like overhead real estate expenses. So car, for example, unless people are full-time real estate, if somebody just like is a nurse and invests in real estate on the side, most often they're not writing off their car. Because they don't know how to, or they think, well, I'm only writing off when I drive to the property. I don't drive there that much. So it's really important to understand, like, what are all the different things you can write off. Basically, when you spend money on something, ask yourself, is this something that's ordinary and necessary for me as a real estate investor? And if the answer is yes, you should track that expense. And even if it's not deductible, let your CPA tell you it's not a write-off. If you are not tracking it and you already determined it's not a write-off, your CPA probably never sees it, and it's probably not going to be written off, right? So that's the one thing I always tell people, like,
don't forget to hit that subscribe button and turn on your notifications. Now let's get back to the episode.
Educate yourself on what you can write off, and if you don't know the answer to something because it's maybe a little bit ambiguous, then just ask your CPA. Call them, text them, email them. Hey, I'm about to spend X dollar amount on something. I'm going to buy a new car. Can I write it off? How should I pay for it? LLC, personal name. Just simple things like that. But I get what you're saying. Those people are always concerned, like, am I writing off too much where I can't get a loan? That's always like the fine line that we walk. So from that perspective, I think it's really important to just have a really good relationship with your loan officer or mortgage broker. Because what we'll often do is, like, we'll do a tax return with all the write-offs that they're legally allowed to take, but we don't file them. And then we'll say, hey, JR, send this to your loan guy. I want to know what he says. That's what I do. Because some of the time there's some write-offs that you can take and it's not going to hurt you. And there are others that will hurt you. And if you're trying to get $1 million loan, maybe you forego writing off a home office, right? Oh, and then you just kind of make that decision. Is the depreciation added back as income? Typically, yes. Yeah. Now, cost segregation, depending on which lender you work with, if the good ones, they know how to explain it to the underwriters so that it doesn't hurt you. But sometimes they don't understand it, and that could really hurt you because it's hundreds of thousands of dollars of a write-off. And that's what separates a good loan officer versus a non-experienced loan officer. Yeah, like you need to work with someone that works with investors. Right? Yes. So they commonly see those large items. That's a lot of depreciation, and it needs to be underwritten correctly so it could be added back as income. Right. I had, this is the true story, okay? I was qualified for, let's just say, 1.1 million, right? I tried to get a home equity line of credit with the same taxes. And it denied me for the line of credit, and they approved me for 1.2, whatever. Same bank? No, different bank. Different bank. Okay. Bank of America, and then I had, you know, because they had to underwrite every single one of the properties, right? Depreciation, then add it back. Yeah. So it's just, and I was pretty pissed. I was like, what do you mean I just got qualified? And it didn't happen. So it just shows that having the right people makes a big difference. Yeah, yeah. And two, like, once you file your tax return, right, and then you go talk to the lender, it's like too little too late. The return's already been filed, and the lender wants to see his transcript, and that shows like these big losses. Yeah. And sometimes the write-off you give up is so small in comparison to getting that large loan and the best interest rate. So sometimes it's a business decision, right? It's like, I want to maximize my write-offs while optimizing my ability to borrow. But I think now the landscape has changed as well in terms of these programs that are available nowadays. You don't even have to provide your taxes. Yeah. I didn't start like that. So all this is new to me too. Like, I'm like, wait, what? What do you mean you don't have to show taxes? Or like, you just show bank statements? And that's what we do now. We do bank statement loans and all that. Yeah. And it's just, sometimes I'm like, wow, this is, you know? Yeah. Well, to me, the best way to always go is the right way, right? File your taxes, show income, and get the best rate. Yeah. But some of these programs, they have some good rates. And I'm like, man, you don't even have to provide taxes. This is wild. Well, and also, too, like for larger commercial real estate, right, it's based on the performance of the property. More so than they don't care what JR makes. Yeah. They want to make sure the property sustains itself. Yeah, exactly. So I think a lot of like newer investors are always concerned with like the 10 loan max. Like, oh my gosh, what happens when I maximize and my wife? I'm like, well, by then you have 20 rentals and you're probably going to scale up into a multifamily anyways. So maybe you care less about, you know, just get that first deal. Exactly. Focus on the first one. I don't know if this is a CPA question. How many residential loans can one individual have? Well, I mean, typically it's 10, right? The 10 loan max per person. And that's why you see people who like, you know, maximize his versus hers kind of stuff. But there's always different loan programs like you're talking about, right? Where they don't really care. Yeah. Or you take out like portfolio loans where then you know, put 5-year properties into, that's considered like one loan. So. Yeah, because I think I heard that, it's no longer 10.
they just they raised it to like 15 or something like
I mean,
that.
it's possible.
I was like, oh, okay.
Yeah, I feel like the loan, it's kind of like lending law is similar to taxes, right?
Yeah.
It's always changing and it's different for every state. So,
what are some of the, people file their taxes every year, or at least they should be filing every year. What would cause a red flag for the IRS to audit you?
Oh, that's interesting. So, IRS doesn't really tell us what the red flag is. And when you're audited, some auditors will tell you why you're flagged, others won't. So it's kind of up to them if they want to share that information or not. What's really interesting is, a couple years ago, the Biden administration gave a lot of money to the IRS, and they had a big focus on high-income earners and real estate investors, right, specifically. And so because for our clientele, it's mostly real estate investors, even though we have, professionals and entrepreneurs, they come to us because of real estate, like, hey, I want to grow my real estate. So we have a pretty decent increase in audits come through our office in the last couple years. So just all that to say, this is just in our firm. It's not representative of I don't know, globally or whatever. Most, if not all of the audits were results from something super silly, like a missed 1099 or I didn't give you my 1099 from this fidelity statement and I sold some stocks. Or we had 2 people who were flagged for audit because they didn't give us a W-2. So it was like, oh, my wife got this little part-time job for 2 months. I didn't even know I was getting a W-2. And it's so crazy because there's such little things. But some of these investors, I mean, one of the ones who was audited is, I don't know, he's probably got I don't even know, lots and $8 million of tax, depreciation stuff. And so they had to look into all of that just because one little missed W-2 that the wife had that was for 2 months. So what does this mean, guys? This means remember all of your investment accounts. Remember if you or your wife got a W-2 or a 1099, however small you think that is, like $10 from the bank, send it to your CPA because that's just very silly mistakes to then have this big audit for no reason.
Yeah, I would probably lose it if I was to get an audit just for that.
And, people think or CPAs say, oh, it's because of your cost segregation. It's because you're claiming home office. You're claiming too much advertisement. At least in our firm, those were not the reasons. The reasons were just something super silly.
And when can somebody claim a home office?
Anytime. Anytime you have an eligible home office. It's just about...
it has to be legitimate.
Right.
You have your own space.
Yeah.
Not just a desk.
I mean, you could have a desk, but the desk just has to be in an area that's only used for office. It can't be, I'm working from my dining table. That's also my home office. So it just has to be a separate space.
Darn it. Nah, just kidding.
But so many CPAs are afraid of it. They're like, oh my gosh, you can't claim it. You're going to be audited for sure, which is so silly because IRS actually changed the tax law several years ago. This is maybe 10 years now, where they said for home office, I'm going to give you a standard $5 per square foot. You just take it. I don't even want to see receipts. And then it was compounded by COVID, right? It was mandatory. Everybody's working from home.
Working from home.
So, and the reality is, I know you have a nice, beautiful office here, but most real estate investors, a salesperson just investing in real estate on the side, they're going to manage their rentals from their home. They're not out here renting a space to manage their 3 single-family homes, right?
Yeah.
So home office is a commonly missed one for real estate investors because most of them don't rent an office.
Yeah. That's too bad I can't right off my dining table.
I mean, the reality, too, is the bigger your home, because the home office, you're basically writing off a percentage of your home expenses, like your home insurance, utilities, and all that stuff. And so what that means is the larger your home office space is, the higher the write-off. Okay. So if your write-off is, if your home office is actually just that little table, probably not very big. But if your home office is the basement or the loft, then that's pretty big.
That's pretty big.
Right? It's a bigger write-off.
what are the write-offs that people forget to write off when it comes to their investment property?
For the property, I think overhead stuff, we mentioned a couple, right? Car, home office, if you have your kids work for you, pay them. That's one, like, I don't know. So many of our clients, I always have to remind them because I see them on social media, like their kids doing stuff. And I'm like, hey, make sure you're paying them. Property specific one, I think the biggest one I see is probably insurance. I don't know why people miss insurance cost.
Man.
All landlords should have insurance. So whenever I see a return with no insurance, I know that's missed.
They're not going to miss it this year, though. That's a
Well,
high
that's
one
a high
right
one
now.
this year.
You don't
That's a
even
high one
know
this
the
year.
stress I went through November. I almost, we don't want to get into that.
Yeah.
They won't miss it this year.
This year they won't miss it. But historically, it's just one that we see missed pretty frequently. I think another big one is like closing cost. And this is an investor, like if you're an investor and you go to your CPA in the next couple weeks or anytime, don't just tell them like I bought a property on Main Street for $100,000 or let's say $500,000. Because some CPAs are lazy. They're like, okay, what's the street address of $500,000? Great. And that's it. You want to give them your closing disclosure because that has all of that cost, like prorated property taxes, insurance, interest, and all the loan cost. That's another one we see a lot. Like on the depreciation, it's just like $500,000. Like where's all of the other stuff?
And that pertains to refinancing.
Yeah.
As well.
Yep. Everything that's on a closing disclosure, send it to your CPA.
When you refinance your property, guys, you could write the closing costs off. You could write a lot of things that are in that closing statement. So you make sure you send it to your CPA.
Yeah.
Because there's savings in there.
Yeah.
And just for that savings, send me a coffee, Starbucks card.
Send it to me.
Send it to Amanda.
You just got all the credit.
I took all the credit.
Yes. I mean, some of those things you write off, some of those things, depreciate, right? Loan costs, you can like depreciate or amortize it, but they add up. You know? Pay the more expensive the property, the higher the closing cost, basically.
So the reason why I'm asking is because I get a lot of messages that like, can I write off that broken window? Well, you replaced it.
Yeah.
Anything that pertains to the operations of that property could be written off 100%.
Yep. Yeah. You write it off or you depreciate it.
Yeah.
But yes, it should be part of your tax return. So yes, that's first and foremost. Anything related to the real estate should be written off. And then these other things that are personal but also real estate, those are the things you also want to make sure you capture, right? Like my home, my car, me going to a real estate meetup, but I'm also having like a little fun because I see my friends there. You should track those too. Because just because you're enjoying being there at a meetup or a conference doesn't mean it's not a tax deduction, right? Yeah. It's not property related, but it's real estate related.
And if you're going to a property management seminar in Hawaii.
Are you putting one on?
Is that a tax write-off?
Yeah. I think, it's, when you're talking about like traveling for a seminar, that's naturally built in, right? You're going to have tickets and all that kind of stuff. What I always warn people is like, the difference is, okay, you're putting on a seminar, I'm going there, I bought tickets, so obviously I have proof. The reason I'm going to Hawaii is for the seminar. But if you're like, hey, I'm in Hawaii with my family, let me pick up an open house flyer, that's not a tax write-off. That's just you happen to look at real estate, right? So that's the difference of like what a TikToker will say versus what a CPA actually says.
So Bigger Pockets, I see that you collab with them a lot. Did they help you with your book, or how did that come about?
So so back many years ago, my husband Matt and I did a lot of speaking. Like we taught about taxes in the multifamily space, and then that was and one day I got a call or email from Brandon Turner, and he was like, hey, we have this little podcast, can you hop on? I'm like, yeah, sure. So I didn't know what Bigger Pockets was at the time. I don't think it was big. I think I was one of the first many ever episodes.
It was probably in its
infant,
infant upcoming stages.
Yeah, and so that's sort of how I think I was probably like the first CPA, and I remember they were very nervous because it was Josh and Brandon interviewing me, and they were like, hey, Amanda, we got to make it fun. Tax is super boring. We got to make it fun. And so they were like joking around with their cat. And I was like, man, like, who are these clowns? But anyways. And then like sort of nothing happened, just like, okay, I was on the podcast. And then for a while I was getting all these prospects calling like, hey, I heard you on this. I heard you about, Brandon talk about you. So I went back. I'm like, what's this Bigger Pockets thing? And yeah, so just kind of like started, working with Brandon and Josh. And so when I had an idea to write a book, I was like, well, I'm going to ask them if it's something they're interested in. Because I think at the time they only had like 2-3 books, by them. Okay. So yeah, I just kind of had an idea and I was like, maybe I'll just see if they were interested.
Is that process difficult?
I mean, it is now because Bigger Pockets is blown up and they have like a whole committee and a department for it. Back then it was just like, here, Brandon, here's a table of contents. Like, let me know what you think. And he was like, looks good. But the reason we wrote the book was because, this is funny, my husband and I were on a cruise, just the two of us. And it was back when internet was super expensive on ships. And so we brought a bunch of books to read, and we brought tax books because that's what 2 CPAs do. Like, no joke.
How fun.
And what I realized was like the books were so boring. We were like, how could anybody read this kind of stuff? Like, we're CPAs and it's so boring. And I was like, what if we wrote a book that actual non-CPAs will read? Like, real estate investors will read it and be like, wow, this is cool. I would like to do it. So we just started jotting down like client stories. Like, hey, we're like, oh, Brandon, remember he did this? And that was the start. That was the chapter outline that I sent actually to Bigger Pockets. It was like just different stories of like, hey, this person did this and this person did that. So
really?
That's for any of you who think like you would never want to read a tax book, you might be surprised at how much you would enjoy it.
And how much you will save.
I also talk about not just like client success examples, but also nightmare examples too. Like what happens when you do things incorrectly. Because I think that's just as important, right? What not to do.
Well, how do you bring that up? What is the most common thing that somebody does incorrectly on their taxes?
Gosh.
I know such a broad question, but.
Yeah, I will say, I think there's two things. There's the investor's mistake and then there's a CPA mistake. So investor-wise, I think we already touched on is just not really understanding what their write-offs are. So they don't send it to their tax person, right? They're like, I'm not even sure. I'll just give you whatever I can. So to get this return done so I can just move on with my life. So I think that's probably the most common mistake is time and time again. I talk on podcasts all the time, and then I talk to clients, and they're like, oh, I didn't know you can write that off. And I'm like, I literally say it all the time. So I think that's just the common mistake, still just not understanding what to write off. But I will say the bigger mistakes, unfortunately, are usually made by CPAs. And those are just like not taking depreciation correctly, either not doing it or not optimizing it. I think you might be shocked at how many people that I go on their podcast. I'm not saying you, but people will say like, oh, I love my CPA. He owns a lot of real estate and, blah, blah, blah. And then later to find out they've never done cost segregation. They've never actually done a lot of these common things. So I think anything related to depreciation is a common one because unless your CPA is really well-versed in real estate, it's just something super niche that they think they're doing it, accelerated depreciation, but maybe they're not actually doing it correctly. I'm not saying it's you. I'm not saying it's you. I'm just
no, but that's a great point. Cause I'm like, is my real estate? Is my CPA? Is his niche real estate?
Here's what you can do. Okay, like so. Let me tell you this.
Amanda,
this is a
here I come.
So I was on a podcast like this is maybe 2-3 years ago now, and the host was like, "Yeah, I love it. My CPA does real estate. Like he owns real estate, so super great." And then one day, a year or two later, he messaged me and he was like, "Hey, I need to switch to you because my CPA. I asked my CPA how much is cost segregation going to save me this year, and he didn't really know what I was talking about." So this person was assuming the whole time they're doing cost segregation, right? Because why not? The guy owns real estate. That was the first time. So if you don't know whether your CPA is doing it correctly, that's a really great question. Don't say, am I doing cost segregation? Are you doing depreciation? Am I like saving taxes with real estate? Those are very generic. You just ask them like, how much is cost segregation going to save me? Because they actually have to know. Like, they would have analyzed it, right?
And the chances, and people will be surprised if they ask their CPA that question. How many actually know?
Yeah.
What that is.
And I think that the thing and it's not anyone's fault, but most people assume that I'm paying my CPA money to do taxes. They're the expert. And my CPA knows what I do, right? Like, JR, your CPA knows you do flips and you do rentals. They know all that. But sometimes maybe they're not claiming you as a real estate professional. Again, I don't know what the rhyme or reason is. So there's that miscommunication of you assume they know all this and they are doing it for you, but maybe they're not. And so it's kind of just like, just confirm it. Just ask.
I asked 21 questions. Yeah. So when
you're the client that no CPA wants.
I mean, like, so tell me about this. Like, I called them. I'm like, all right, I'm gonna flip this property, but I plan on putting this property with this S-Corp. Well, actually, he's the one that told me. Because I'm like, I'm going to get another LLC.
Yeah.
He's like, why?
Why? Good. That's a good question.
And then he's like, why? And I'm like, because I'm going to flip and I'm going to hold it on this. He's like, we hold no real estate on that S-Corp.
Yeah, yeah. I like how he has drilled it into your head. Because when you say it, it's like
And he knows how I am. And I'm like, okay, I have no. He said, so why are you going to go open another LLC when this one right here, this S-Corp, we use it straight for real estate and you own no assets in there.
Right.
This is going to be a flip, right? And I'm like, yeah. He's like, use this one. I'm like, okay. But it's because you hear all these other people like, no, you can't use an S-Corp for that. I'm like, well, you don't do my taxes.
Yeah, right. And the entity conversation is so specific to that person, right? Because like what might work for, like, okay, you're building you buy a property, you're building ADUs on it. Thatch is buying real estate and building ADUs on it. It's like seemingly the same transaction, but the structure that's suggested by the CPAs might be totally different. Yeah. Because you have other stuff like your brokerage or whatever. Yeah. And then, I don't know, Thatch might have other, different things. So
I don't ever want to hold a buy and hold investment in the same LLC that I'm going to have this flip under.
Yeah. Or commissions, right? You have like the set of entities where your assets are that are growing. And then you have another entity or series of entities where your risks are, right? Selling real estate, flipping, being a property manager. Those are all risks.
Yes.
Those own nothing.
Amanda is on point. I need to get your book.
You were supposed to say, I read your book and it was so great.
I'm going to read it and I'm going to say it's super great. I have to be honest. I just seen that. I was like, she wrote a book. I should have ordered it since last week. So like I would have been like, this is amazing. But when I read it, I will.
Yeah.
What motivated you to write that book?
Well, I mean, like I said, it's just reading so many boring tax books. It's funny. So my husband and I, we both started at one of the big 4 accounting firms. And so the clients we worked with are very wealthy people. Like the Irvine Company was one of our clients. Okay. Right? I mean, they own Irvine. And so just very large real estate development, high net worth individuals. And for those people, tax planning is like such a normal thing for them. Like they have CPA and attorney on speed dial text, right, all the time. But when we first started investing, like going to meetups and stuff, and we met like regular folks and like people like us, and then we realized like, oh, regular people don't do tax planning. Like they have no idea what that is. It's super foreign. And so we had this passion, like, why don't we just take all those same strategies that we use in the big 4, but in a simplified version for just everyday investors. So because that was our mission, we're kind of like, well, let's just write a book, because if you write a book, I think with stories that are relatable to people, like their frustrations and the unknowns of tax in general, then maybe they feel a little bit more empowered. Like, maybe I don't hate taxes. Maybe there's something I can do about my tax situation. So I think for us, that was sort of like the why. And also, we were really bored on a cruise ship with like no internet, so we just write stuff down.
And to me, it's like, how do you make a tax book fun? The reality is taxes and real estate is pretty boring, you know?
Yeah. Yeah.
So it's like, man, how do you make that fun? So I'm curious to read it now.
Yeah,
Like,
should. I mean, I don't want to oversell it. It's not like super fun. It's just not what you're envisioning as like, you know, a bunch of numbers and calculations and like tax jargon. It's not a lot of that. Okay. It's literally like, you know, the story of JR, like when he started out and he flipped he flipped a property in the LLC and he paid a ton in taxes. So he talked to a CPA. Now he got an S-Corp. Yeah, it's a story.
Real,
of,
like,
yeah, like
not super like big time. It's just for the average people.
Yeah, like one of my stories is about a cop client of ours, and it's funny because we change all the names for our clients. That was the only client who like called me and was like, "Is that me? Am I so and so? You know, like, am I Billy in the story?" I'm like, "Yes, it is." But yeah, we talked about how like he used his he started investing with his kid, so he was like retiring cop and invested with his kid, and how we structure like the trust so that his kid would get his assets without having to pay taxes in the future. Because his kid was just like starting out in real estate, right? So just little stories like that.
Oh my God, you brought up something so important.
What was it?
Light bulb.
We will be here for 2 hours, right?
How do you structure your assets so your kids don't have to pay taxes?
Well, it depends. It depends on like your net worth, right? Everyone's net worth is a little bit different. But right now, the current law is every person has roughly $13 million that you can pass on to the next generation without any estate taxes. So if you're married, that's what, $26 million. So if you're someone whose net worth is $26 million or less, which may be most of the audience, what you want to do is you actually want to have your kids inherit the property. Whether it's property or stocks, right? Anything that's appreciated over time.
Inherited through a living trust.
Through a trust, through a living trust. This is the most common way to do it. And so, for example, if you buy a rental property for $100,000 years and years ago, by the time you pass away, it's worth $1 million, right? It's appreciated $900,000 over your lifetime. You've done the cost segregation. You wrote off everything. If you give it to your kids and start adding them to title when you're alive, then they will pay taxes on it as soon as it's sold, because they have no more basis. But if you keep it until you pass away and then they inherit that at what we call fair market value we call it step-up basis. So they inherit that at the $1 million fair market value on your date of death, which means if they were to sell, the first $1 million is tax-free to them because they got a step up. So for most people, we have to be very careful of like, you know, when you set up your trust, if you have one or multiple kids, that they're inheriting it upon death and you're not giving them ownership right now when you're alive. And giving ownership is as simple as like adding them to title. And parents will do that. Like I say, because my mom did it. Like my mom has investment properties. One day I found out I was on title to one of them. And I was like, why? Why did you do that? She's like, oh, I'm getting older. You know, I want you to like sign paperwork in case I have a stroke. And I was like, you can do that. Give me the rights to help you sign, but I don't need to own the real estate, because if I co-own it with you, now when you pass away, I'm going to have to pay tax, right? I don't get the step up. So I have to pay tax on all the appreciation through your lifetime if I sell. So very important for younger and older generation.
I'm over here.
I don't get the stroke when I have to pay these taxes.
Yeah, we have stroke together.
Okay. And how about the Prop 19 implications? That doesn't. Tax. Okay, I'm thinking a lot. Oh, yeah, this is good stuff right here. So each individual, they could get up to 13 million, right? Yeah. So that means, 13. So what if they do decide to keep the asset? So then what happens then? If the asset isn't being sold, they want to keep it and continue generating income.
Yeah. For the kids, you mean?
Yes.
Once I inherit, that's fine. So let's say that my mom, let's say it's in my example, my mom bought something for $100,000, passes it to me when it was worth $1 million. I hold on to it for years and years and years. And then by the time, I pass away, it's worth $3 million. I give it to my kids. My kids will have it at $3 million. And they eventually sell it for $3.5 million. Then they pay taxes on the $500,000.
But if they don't sell it?
Then you just keep holding on to it.
So there's no...
there's no expiration.
And there's no death tax.
Well, the estate tax, right, is, like I said, that was when you hit the $13 million per person, that's where it kicks in. So for people who are higher net worth, like let's say you are already over the $26 million as a married couple, then we have to look at kind of more advanced estate planning where you do start to shift some of your assets during life, but you still want to preserve at least the 13 to 26 million because that part is still free. I'll tell you the mistake I see people make, like practically speaking, the mistake I see people make is like if parents are retired, right? Then you or this next generation has high income and maybe parents need to refinance their home, like their primary home or their investment property. They don't have income to show to refi. So you just co-sign. You co-sign the loan and the lender says, oh, you co-sign, you're going to be on title. That's where the problem happens, right? That's just like small things like that. And now you're on title. Big. Maybe you don't even think about it. You don't know it. One day your parents are going to sell. You get a 1099. And you're like, what happened? Oh, years ago I co-signed on a loan.
I have a question. What if you co-sign, but after 2 years you can remove yourself?
Yep.
You can avoid the taxes.
Well, you could co-sign and not be on title.
Exactly. Co-sign and not be on title is the best way because you are never on title.
Yeah.
But yes, if you have to, then you want to remove yourself as soon as you can. Because otherwise, you don't want to be on title at the time of sale, right? Then that's too late to remove it.
This is so important. This is gold right here.
Yeah.
Because we all, especially in the Latino community, they make that mistake.
Yeah. Well, Asian people too. And I don't know about Latinos, but Asian people, like, we don't talk about money a lot. So these things happen without you knowing it. Like with my mom. Like I had no idea.
It's like we don't talk about money and we don't talk about death.
Oh,
Those
yeah.
two things that we don't like to touch on in the Latino community.
Yeah.
These are things that we need to touch on.
Yeah. It's super
because it's very important.
Yeah.
Because there's a lot of things that need to get resolved before that happens.
And that's when you have like one of my friends is an estate planning attorney. A lot of what he does is like go to the hospitals, go to ICU. He has to make sure the patients are still aware, but he'll have to go there and make them sign stuff, like sign the deed back, create the trust and sign it, like all those little things. And that's the last thing you want to be thinking about, right? Like parents are dying, you're like, attorney, please come.
I made my parents get their living trust.
Oh, good. Okay.
He didn't want to.
Yeah. You're like cursing. It's almost like you're cursing them, right? To die.
I'm like, listen to me, buddy. I said, this is the day that I scheduled with the attorney. And this is the day you're going to go, and you're going to do it.
Yeah.
There's no... And he looks at me like, okay.
Yeah.
And I was like, the last thing you want to deal with is probate and all this other madness going on when you're supposed to just be mourning.
Yeah. Yep.
You know what I mean? So...
And also, too, if you have, like, multiple kids, right? If you don't have it in the trust, then brothers become enemies because... you start fighting for this stuff. So I know it's tough. It's a tough conversation to have with parents, especially in certain cultures, because it's like taboo, or it's like you're not being respectful when you ask them to do these things. Like, I'm not dead yet. Why are you thinking about my money?
I mean, one of the weirdest situations that I've been involved in is the process of my living trust. Like you didn't. It's like you're planning. It's like I'm planning my death. I'm structuring everything for when I die.
Yeah.
And that's just a weird feeling. Like now you're gonna be like, okay, well, which child do I like more? Who gets more? And it just.
Yeah.
I understand that it's just an uncomfortable situation, but it's something that has to be done, or else you're gonna have the state take over your stuff.
And
the same thing happens with take care of that while they're alive, and
Yep.
something happens, and then there's GoFundMe's, people doing car washes.
GoFundMe
Yeah.
activities, you know?
You didn't like plan for all the after deaths. I mean, death is super expensive.
Yeah.
But I think one of the reasons that people, I think a couple reasons why it's taboo. You don't want to like jinx yourself to die. And then also sometimes parents don't want to reveal to the next generation exactly what is available. We see that a lot. Like, I don't want my kids to know what I have because then they maybe not work as hard. So I think those are a couple reasons. Oh, and I think the third one is loss of control. People don't understand how the trusts work. And so they think, oh, I'm going to put in the trust now. Like, what if I want to disown JR? Like, what happens? Or I don't like JR's wife now and I'm going to disown him. But the living trust, it's revocable. So you change it however you want, whenever you want. Right?
Yeah.
So I think it's important for them to understand, like, the ability to change. So you're not so afraid. You haven't given anything away yet.
But
you can disown anyone still.
But I just think since they're transferring title to the trust, they're like, oh, I'm giving away my property.
Right. But you are the grantor of the trust.
You're giving it away to yourself.
Yeah.
Like, you still have full capacity and you could do as you want with the assets. Like, it's not saying I'm just no longer, it's yours.
Yeah.
Until you pass, then it's becomes.
And change your mind anytime. That's the thing. But I'm a big proponent of that, especially for people who are like, oh, I'm just getting into real estate now. I'm going to set up my LLC. That's a good time to start looking at trust, especially if you have kids. Or if you don't have kids, you don't have assets. Sure, you buy, get a car wash, and raise some money, raise money for your funeral. But if you're married, you have kids that obviously you want to make sure they're taken care of. You have assets. The time to set up the trust is also a good time to look at your LLCs because they kind of flow up together. My real estate held by my LLC. Who's the member of the LLC? My trust that I just set up, right? That's good. Then you don't have to like set it up in your name and then later move it to the LLC. It's a good time to just clean up.
And you could have each LLC in that trust. So the trust manages these LLCs.
Yeah, the trust owns the LLCs. It has like your brokerage accounts, 401k accounts, like basically your home, right? All of your assets. Because then your trust dictates what happens if I die, who gets what, and at what age they get it.
Now, let me ask you this in terms of tax purposes. When you have life insurance and it's payable to an individual, it's not taxed.
Correct.
Now, if it's paid to the trust, is it not taxed or is it taxed?
So we rarely, so insurance proceeds are generally tax-free.
Okay.
Just by definition. Okay. So regardless if it's paid to a trust or to like a child or whoever the beneficiary is. However, we generally don't have the beneficiary be a trust because usually when people are using insurance as part of like estate planning, it's usually people who have higher net worth. And so even though it's not subject to income taxes, it's income tax free, but you may have to pay estate taxes, right? That 13 million exemption. And so typically those things are outside of that trust. They have a special trust that are set up for insurance purposes.
Yeah. So I think it would be best for it to be payable to an individual.
Yeah. Yeah. Usually, that's how we, typically see it because you don't want to have that in the estate, right, as part of your estate taxes.
Yeah, that's man, this was very informative, and
I'll send you my bill.
Thank you, man. Like,
a tax consulting bill.
Yeah, I'm gonna send her. Do you like Starbucks?
I don't drink coffee.
You don't drink coffee?
I know. I'm such a weird person. I also don't drink tea. I don't do well with caffeine. Yeah. But I'm okay with tequila. And people always say, like, oh, you don't drink caffeine, so you just also don't drink, alcohol, right? Just water. But, yeah. I don't know. Something with caffeine.
I'd rather drink coffee than drink tequila. I love being... I'm already high-strung. I drink one coffee a day, though. That's it. Because I'm already, like, high energy. Yeah. So if I drink more than one, it's over.
I try to drink coffee because when I tell people I don't, I get these kind of reaction. Like, I'm so weird. So I try to drink
you're
coffee,
not.
but I can't. Like, I like the smell of it. I like coffee flavored everything. Ice cream, cakes, all that stuff. Yeah. But yeah.
It's funny
Drinking is
that
hard for me.
when I tell people like I don't drink, they what? You don't drink?
See, that's
I
the
feel like
thing
I just
about
did that to you.
Yeah. Same thing.
So annoying. I am sorry, Amanda. like what do you mean? You don't, like I'm the weird one. Like poison. Like like.
I actually read a book about it. It's I think it's called Caffeine.
Uh-huh.
It was really interesting. It talks about the culture of how drinking coffee is so welcomed and acceptable. That almost like at work, when you have when you're working, it's it's a coffee break.
Uh-huh.
Everybody goes and hangs out, and if you don't drink coffee, then you miss out on very important conversation. So that's what I used to do when I had a job. Yeah, but you want to gossip. Yeah. I would make my little coffee, go hang out and then just dump it out because I'm not drinking.
That's what I do with tequila. I'm like, oh, shot.
Can I tell you, if you follow me on social media or YouTube,
I do follow you.
In my videos, if you look close enough, I have a coffee mug. Because again, I'm like a fake coffee drinker. But if you look close, it's water inside.
Oh, shit. Just playing the CPA part. I'm a great CPA and I'm always energized. Yeah. And it's fucking water, it's fucking vodka, tequila or something.
Yeah, by water I meant vodka.
Oh, man. Any questions?
I do have a question for you. I would want to know your thoughts on what's going on with the IRS and just all these findings, right, of mishandling of funds in the government.
Doge.
Yeah.
Like the IRS. So how that's going to impact upcoming tax season, because I don't think this tax season is going to get impacted next year.
Oh, for this season is getting impacted already. Oh, really? Yeah. So it's funny because when I post about IRS layoffs, I mean, the followers are like, yeah, those people did nothing anyways. And people love it. But my followers who are accountants, they're like, no, this is terrible. This is the most terrible thing because we already have to wait an hour for someone to pick up the phone. Now it's going to be 5 hours because half of them are gone, right? So I don't know. I think it's just such a waste. I feel like it's a waste of money because just a few years ago, we spent so much money to hire all those IRS people, right? All the agents and okay. And then now we spend so much money to let them go. It's not cheap to let them go, right? I think a lot of times
Severance
you're paying them until September and now they're not doing anything. So it's just ridiculous. That's just an example of how inefficient government is, but it for sure impacts it now. Like today, I have a client who's been audited. This is a crazy example, but the audit started over a year ago. I cannot get a hold of the auditor. And the only time we talked, she was didn't know what was going on. Finally, today I got an email from her that said, hey, today's my last day. So goodbye.
So then what happens in that case?
I don't know. I don't even
dismissed?
know. I'm so who do I call? Yeah, is this gone? I don't know. But I guess I'm not going to ask if she's not going to ask.
Because another thing was the whole tax forgiveness, right, for people that owe because Trump saying that he's going to pay back taxpayers 5,000 or was it 7,000?
5,000 like a credit, right, from Doge because of what they found. Yeah. How's that coming? When's that coming? I don't know. Or even just regular refunds, people who are expecting refunds now filing last year's return. We don't know how long it's going to take. Probably take longer because there's fewer people processing it now, right? I mean, maybe they'll make it a priority. I don't know. But those are the kinds of things. It's it's it takes a long, again, my part is it's just such a waste of money. It was so, you guys, hiring people, training them, very expensive. And now you to lay them off and pay the severance, even more expensive. And the result of it all is no one's doing the work.
They should have just kept them till May. Hey, after April 15th, you could.
I'm hoping they've kept, some important roles, but yeah, you never know. And then, it's funny because last week we closed out an audit for one of our clients. It was a no change audit, super nice auditor. And I just have to say, auditors are actually really nice people, at least the ones we work with. They're not like the crazy people that influencers say they are. But that girl, for example, she was going to be laid off already, but she was finishing her job. And so I was like, how is it at work? Everyone knows you're going to not have a job. And she's like, yeah, it's pretty, low energy, but people just still do it. It's still their job.
Probably the morale is just gone.
Yeah. But then you think about I think it's kind of oh yeah, we don't want auditors. Nobody likes audits, right? But then you see the person and then you're like, well, that person has kids, So they're not going to have money. They're going to have to look for another job, or they're going to be on unemployment, which means you're also going to continue to pay for them if they remain on unemployment. So it's just like a whole trickle effect of, I don't know.
But do you think it's the right move overall?
I think it's the right move. I definitely feel like there could be efficiencies, right?
I agree.
I feel like the money, I've been saying this for years, like the money that the IRS received should have gone to technology, because a lot of what is done could be done by, AI, just better technology, right?
Yeah.
I didn't think we needed to hire so many people to audit. The system could audit easily. It's so outdated. I was talking.
Sleepy Joe.
This is something really funny. I was talking to my friend who's a CPA and was okay. So our job, the hardest part of our job is getting information from the client. And so for the client, it's like, okay, well, you got a W-2 from your job at Toyota or whatever. And then you have to like wait for it to come in the mail, or you have to like log in somewhere, download it. And then you're going to have to email it to me or upload to me. So it's like this whole process. And we're like, well, what if somebody had access to all that paperwork already and just shared it with the CPAs? And we're like, you know who that somebody is? It's the IRS. Why don't we all just share all the tax data, and then I just file the return based on the same data you already have? So that's an example of, if we did that, your life is easier as a taxpayer, my life as a CPA, IRS. No mistakes. We all see the same thing. Instead of like, oh, you got a W-2 that I didn't know about, now you're going to audit me. Like, you already have it. Give it to me.
That's very true.
There's discrepancies too, right?
Yeah.
Because I also think that's not fair that as an individual, you hire a CPA or someone to file your taxes, and if they do it wrong, like, I'm still responsible for it. And it's like, well, they're the professionals. Like, why are you coming after me?
Yeah.
Like, there's just no.
You should audit the CPA.
Yeah, audit Amanda, not me.
And that's the other thing too. Like, I mean, I don't work for the IRS, but if I was in charge of the IRS, what I would do is I would look at CPAs who have clients audited that owe taxes, right? Like a consistent pattern. I would just take that CPA's client list, right? I mean, CPAs all have a number, like a social, right? So I would just say, hey, JR's audits all like pretty bad. Let me get his whole client profile, all the clients I'll look at all of them, run it through some kind of software, and then I'm done. But good thing I'm not part of the IRS.
Yeah. And you're on
crazy
True Hustle
stuff.
Podcast. Yeah, let's go. Anything else? You sure? All right. Then you got to connect with Amanda, because she's going to hook you up. Get you a fat return. Nah, just kidding. Yeah. Amanda, I want to thank you so much for your time. I know you're busy, but you took the time to stop by and bless us with tons of knowledge, and you guys better appreciate it. Let them know where to follow you at.
Well, my company is called Keystone CPA, so you can find me on keystonecpa.com. I have a YouTube channel. If any of the stuff we talked about was kind of like new to you, YouTube is a great place to start. My books, Tax Strategies for the Savvy Real Estate Investor, you can find Amazon, Bigger Pockets, anywhere books are sold. Daily Tax Tips, I'm on Instagram as Amanda Han CPA.
There you go. You better make sure you follow her and you start doing your tax strategies the correct way. I hope you got tons of knowledge, tons of info, and we'll see you guys next week. Let's go. Thank you so much for watching. Make sure you hit that subscribe button and turn on your notifications so you don't miss our weekly episodes. Let's go, baby.